Hello and welcome to another edition of our Index More series, where we at Satrix, in collaboration with BlackRock, bring you insights from the investment trends that shape our investment world. My name is Nico Katzke. I'm the Head of Portfolio Solutions at Satrix, and I will be moderating this very interesting session where we today explore how the US election results unfolded and what it means for global trade, the inflationary outlook, and for our investments, of course. So with us today, we have Jack Eldridge, who is a member of BlackRock's Geopolitical Research and Strategy Group. Welcome, Jack. He is also joined by BlackRock's investment strategist for EMEA, Natasha Sarkaria. Welcome, Natasha. And then, of course, to provide us with a local perspective on asset allocation, we've invited Ralph Thomas, who is the head of balanced funds at Sanlam, to share his views on asset class positioning. And of course, rounding off our esteemed panel today is no stranger to this audience. We have the ever popular Kingsley Williams, who is the CIO at Satrix. Welcome to all of you. Thanks for joining us. And I'm sure those of you dialing in will no doubt enjoy our interaction today. I think it's an incredibly interesting time that we're witnessing. And unless you've resided under a rock, you would have noticed that the US had their elections. And it's now mostly wrapped up, and we can discuss it. Okay, so with the US elections results virtually all wrapped up and arguably surprisingly accepted for the most part across the political spectrum, it's time for us today to take stock of what unfolded and what this could mean for geopolitical and economic conditions going into the next year. Now, 2024 was always going to be an interesting year, with half the world going to the polls. For the most part, voting has largely been peaceful, with a common theme being a pivot away from incumbents. Voters' displeasure with post-COVID asset market turmoil, high developed market inflation, and the general feeling of economic malaise was front and center in voters' minds across the globe, particularly among a younger generation that share a feeling of being increasingly disenfranchised from asset ownership. Now, let's take stock of what happened this year. In the UK, the Tories slipped from a big parliamentary majority to reach its lowest minority share in its nearly 200-year history. In Germany, the governing coalition unceremoniously collapsed, while in France, Emmanuel Macron's party suffered an embarrassing defeat in parliamentary elections. Asia saw a similar pivot away from incumbents, with Japan's ruling party losing its majority after ruling nearly uninterrupted since the 1950s, while South Korea also saw a landslide victory for the opposition. Now, the words of Bob Dylan, that the times they are a-changing, has seldom rung more true among political incumbents than this year, 2024. Now, from this perspective, and of course with the benefit of perfect hindsight, it may therefore seem perfectly unsurprising that the US would follow a similar fate, with voters pivoting away from the deeply unpopular Democratic government, which was run under the Joe Biden administration. After all, rightly or wrongly, voters tend to blame ruling incumbents for their personal economic woes, easily forgetting the external forces at play that shape local economic conditions. Now, notwithstanding, most analysts and virtually every serious political commentator predicted a very close US election. In fact, many held a high probability of the US election outcome not being clear for weeks afterwards, with a high probability of endless litigation and frivolous efforts directed at subverting vote counting in order to delay the outcome and ultimately even the certification of the new government. Yet none of this materialized. A decisive red wave swept the US political scene and thrust upon its electorate a trifecta of power concentrated in Donald Trump's camp, winning the Senate, the House, and of course the prized White House too. Now, swing states all swung red, as the pendulum very firmly went from center-left to right. US voters have spoken, and results have been, for the most part, accepted. Now, the times have indeed changed. And today we unpack what this means, or may mean at least, for investors heading into 2025 and beyond. But before we turn to our panelists, let's get a sense of your own personal take on the global outlook following the recent US election outcome. So on your screen, you should be seeing a poll come up in a second. just see. So there you have the poll on your screen. If you can just make your choice. So the question is, which outlook do you believe will be most applicable in summarizing the post-election U.S. policy environment? Firstly, is it going to be negative, a policy aimed at aggressive tariff hikes, mass deportation, and a deepening of geopolitical fragmentation? Is it a walkback of campaign rhetoric on mass deportations and high tariffs with a less hawkish approach to the NATO alliance? Or are you more neutral? Some honoring of campaign promises, but a more softened and pragmatic approach to internal affairs and foreign relations? Or D, unclear, a confused and inconsistent approach to foreign and internal policy, plagued by a lack of internal political cohesiveness? Which would you think of these different scenarios will be most relevant if you could whip out your glass bowl and look into the future? I see the results are coming in thick and fast. I'll give it one more minute. Now, while you are considering your responses carefully, let me remind you that you will be eligible for CPD points for attending this webinar. Also note that you can ask questions using the Q&A button at the bottom of your screen, and hopefully, time permitting, we'll be able to collate some of your questions and give it to our panelists. Okay, we are almost there. I think most of you have submitted. We have passed the halfway mark. Perhaps I should have made the question a bit shorter for you to more easily digest it. But we're getting there. Okay, so with that, let's look at the results. So a full third of you are more neutral on the policy outlook for the US. So in other words, some honoring of campaign promises, but a more softened and pragmatic approach to internal affairs and foreign relations. About 17% of you are negative. It's going to be a policy aimed at aggressive tariff hikes, mass deportations, and a deepening of geopolitical fragmentation. So in all, I'd say half of you are positive or neutral, and about a fifth of you are unclear. It's going to be a confused and inconsistent approach to foreign policy and internal policy. And it's interesting because I was hoping that the spread is going to be more or less equal across these four outcomes. And it just again shows how uncertain the future is going to be under a new administration that has promised quite drastic measures, both from tariffs and deportations and the like. So it will be interesting indeed to see how all of this unfolds. Now, I'm going to welcome our first panelist on the proverbial stage, Jack Eldridge, who is a member of BlackRock's Geopolitical Research and Strategy Group. Thanks for joining us today, and I'm sure your team's insights have been highly sought after in the past week or few weeks. So thank you for making time to share your views with us, Jack.
My pleasure. Thanks for having me.
Awesome. So firstly, Jack, can you give us a summary of how the election unfolded, and were you surprised in any way by the results? And related to that, how did political analysts so spectacularly misread the U.S. electorate?
All good questions, Nico, and happy to get into them. So first of all, thanks again for having me very much. I was not expecting a Bob Dylan quote to kick us off, so I'm delighted to have had that slip in there. And, you know, I think to start, Nico, a lot of the setup you laid out about the year of elections, the anti-incumbency trend we've seen is spot on. So the stat you referenced, familiar probably to many people here towards the tail end of 2024, but this has really been a historic year for elections. I think the U.S. election result is a capstone to that, and we've had more than 70 countries representing collectively over half the globe's population go to the polls, either holding elections or set to vote by the end of the year, the U.S. and certainly South Africa among them. And it's been a punishing year for incumbents. You went through this perfectly. Incumbents the world over have either lost their majorities or been pushed out of power, and we've seen plenty of examples of that, the U.S. being only the most recent. And I think you were also right about the underlying drivers for this. The most prominent reason, I think, being the lingering economic and social after effects of the COVID pandemic, and that's flown through to persistent inflation, higher for longer interest rates, cost of living pressures, elevated unemployment. All of these things are driving voter behavior, and these types of issues are very hard for politicians as a structural matter. So even in the U.S., despite the relatively resilient economic backdrop, inflation coming down, voters wanted change, and I think we saw that not only when President Biden dropped out of the race in July, but also with the display, with the results on display last week. So as you mentioned as well, heading into the polls last Tuesday, we thought the election would be the closest in history. The polls were certainly the closest in history. It's out of my expertise to do a post-mortem exactly on what the pollsters and pundits got wrong there, but I think there will be a bit of reckoning, although the point about the polls being so close was that it actually could tip either way, as if on a knife's edge, and we saw it decisively tip towards Trump in the red sweep scenario. We were expecting a prolonged period of uncertainty. In 2020, it took the Associated Press 4 days to call the race for President Biden. There were all sorts of procedural issues, including how votes are counted in certain states that mechanically delayed that election result. So with the close margins, we were certainly briefing our colleagues on a period of potential uncertainty once again. But a week ago, we woke up to the clear outcome that Republican candidate Donald Trump was elected to be the 47th president of the United States. And so in terms of the uncertainty going forward, I think it's been diminished relative to what we were expecting. There will be some things to watch, including the state level certification of results on December 11th, the actual voting of the Electoral College on December 17th, and then congressional certification of the electoral vote on January 6th, all before the new president is sworn in late January. But I think we're not as focused on this in terms of potential contested scenarios as we saw play out 4 years ago. So in Congress, as you mentioned, Republicans have secured a majority in the Senate for the first time in 4 years with a 53 to 47 seat split, and they're a clear favorite to take the House as well, though it's unclear how much of a majority they have and a few counts still being formalized there. The bottom line of all of it, this was a big win for President-elect Trump. He's currently on track to become the Republican president, the first Republican president to win the national popular vote in 20 years, and he made significant gains in every corner of the United States and with nearly every demographic group. So just to take a look at a few pieces here, traditionally Democratic strongholds in the states of California, New York, where I sit, and New Jersey, for example, Trump really moving up his margin relative to 2020. So in 2020, he lost California by 30 points. This year, it was only 17. In New York, he'd lost it by 23 points in 2020. This year, it was only 12. Same story in New Jersey, 16 points and now 5. So that's a little bit about the geographic spread of the victory. But demographically speaking, Trump was able to secure and enhance his working class, non-college educated, and rural base, and added to the beginnings of a multi-ethnic coalition, winning Hispanic men and increasing his share of the black male vote in the United States from 12 to 20%. So we're seeing an expansion of that coalition as well. But as we consider these gains, it's important to remember that the fundamentals matter, and this is going back a little bit to what we mentioned earlier. This was always going to be a difficult election for Harris to win, and it seems perhaps easier to say that in hindsight. But the fact is, no incumbent candidate has ever successfully run with 2/3 of the country believing it to be on the wrong track, as asserted by polls, and a 40% approval rating for the incumbent, which was President Biden's approval rating. So Harris, the whole time positioning herself as a semi-incumbent, it was an unusual situation for her to be at one point trying to be the change candidate, on another saddled with Biden's record, and only once, in fact, in the last 188 years has a sitting vice president in the United States ever successfully run for president, and that was George H.W. Bush in 1988, as a bit of trivia. So I think it was always going to be an uphill battle, and that seems, again, clear in hindsight as we sit here and chart a path forward. So I'll leave it there with some broad reflections on the outcome.
Brilliant. Fascinating election. And like you mentioned, I mean, we scheduled this webinar to be today so that there's enough time for us to have clarity on who was elected. And I think we could have had this webinar the day after, almost, it seems, in hindsight. So certainly less tight as we predicted. An interesting other point, Jack, is I saw this morning that Trump nominated a current Fox News host to be appointed Secretary of Defense. Someone many critics have pointed out as being inexperienced and mostly untested on the global policy stage. Now, the fear that some have is that this is a harbinger for a new administration that will be picked based on proven loyalty to a person, not necessarily based on merit. And so proponents may argue that this is a good thing, right? This past, considering, how in the past there's been almost a constipation of policy because there's all these differing views, and that aligning views from that perspective of being loyal actually makes sense. So some have actually seen that as a good thing. Now, considering our polling results, where do you personally see policy direction heading under this next administration? And particularly, what could the next 100 days look like under a forming Trump administration?
Yeah, so certainly one of the main things we're looking at going forward, absent some of the potential contested election procedural elements, is now the shape of Trump's cabinet, the shape of his inner circle of advisors, and the transition process. So this is a structured entering of the new president into in preparing for office that we're seeing, and we've seen some names just in the last 24 hours, 48 hours come through. It's quite early, and the rumor mill is still going strong on a few of these names. But perhaps instead of commenting individually there, to your question, I can give some perspective on generally the policy areas. So I think critical to this, the implications of that likely red sweep scenario we talked about, where Republicans control both the executive branch and both chambers of Congress, will certainly be significant from a policy perspective. Unified control of government would give Trump significant leeway to enact his agenda across a range of dimensions we've been tracking over the course of this long election year. Fiscal policy, trade, immigration, energy regulation, the list goes on. And we expect a very different foreign policy approach under President Trump, which we can discuss as well. But maybe a few general comments. So first, on the fiscal side, if the red sweep is indeed confirmed, we would expect a full extension of the 2017 Tax Cut and Jobs Act alongside efforts to introduce new cuts, including the corporate taxes. On trade, a big focus for us here at BlackRock, for the markets generally, Trump has proposed a wide range of tariffs, as you alluded to, including 60% on China, potentially 10 to 20% across the board universal tariffs, and tariffs on a range of other areas. And this will be an early priority for President Trump, thinking about his first 100 days. Protectionism is one of his longest held views, going back to his entry into public life in the 1980s. But implementation is uncertain, and a number of his tariff proposals could face legal challenges. Generally speaking, this protectionist stance reinforces a theme of geopolitical and economic fragmentation that we've been thinking a lot about at BlackRock, which is one of the structural forces, indeed a mega force, that we're tracking at the BlackRock Investment Institute as we see keeping inflation higher in the longer term. On regulation, Trump's win likely means some deregulation, including rolling back banking regulations. The big tech will likely remain a bipartisan antitrust focus. In the energy space, we see Republicans aiming to boost energy production, though I'd note that U.S. oil and gas production is already at record highs, and ramping up production takes some time. And while there may be efforts to scale back parts of the Inflation Reduction Act, a landmark piece of legislation passed under President Biden, like electric vehicle credits, for a variety of reasons, full repeal seems unlikely. And last, permitting reform is an issue in the United States will be a central focus for Trump as he seeks to expand energy infrastructure more generally. So these are a few of the policy areas that we know are a focus for him from his first term, from what he said on the campaign trail. And key will be formalizing that makeup of Congress, as I mentioned, looking at who's coming in, particularly because where Trump might not have a central focus on some of these issues, he certainly will have advisors that have their own agenda and focus, and they will have quite some leeway to enact parts of these policies. So the personnel, the emerging priorities, that's what we're really watching for going through to the inauguration in January.
And certainly worth watching. I think, lastly, before we let you go, I want to get your take on what the U.S. foreign policy approach may look like going forward in terms of trade and defense specifically, trade and defense cooperation, following a campaign that was largely run on an America First focus, right? And what concerns do you have for the broader geopolitical landscape under the Trump administration for the next 4 years?
Yeah, so I'll say a few things. it's another key element of the policy platform that we're watching, foreign policy, America's role and engagement with the world. And I think from a headline perspective, we can say with some certainty Trump's foreign policy will represent a dramatic change from the Biden administration. This is again based on Trump's first term, what he said on the campaign trail, and criticism of the Biden administration approach that Trump has made along the way. So in the time we have, instead of going around the world and looking at some specific issues, I'll say a few comments just in terms of offering a general framework to understand the likely engagement model with the world that a second Trump administration would have. And I think these are all analytical points. And if President Trump were on the call, he'd agree with them. So very much analytical and nonpartisan as a framing. And the first thing to say is Trump's approach is highly personalized. It includes his assessment of the personal history he's had with the leader or a set of interlocutors he's meeting with. His approach is highly transactional and zero-sum. He's made this point clearly, and I think we saw some of that in his first term. And critically, as you just mentioned, trade is really at the center of Trump's foreign policy approach, and that is why we're focused on it as one of the key policy areas. During his first term, Trump would often ask about the trade relationship before he headed into a meeting. He sees this as a bit of a scorecard vis-a-vis the U.S. relation with a given country, again, or leader. And broadly speaking, he sees trade and particularly tariffs as a tool of general foreign policy application. So he thinks they can be anything can be used to do everything from addressing the trade deficit to pushing countries to move manufacturing back from abroad into the United States, sanctioning the non-use of the dollar, and indeed having tariffs act as a general source of revenue for the country. So that is why outside the headline proposals of 60% on China, 10 to 20% around the world, we're looking for ad hoc use of tariffs as a potential application of foreign policy within this administration. Trump has a different conception of allies. That's something he's also been clear about. It ties back to the transactional nature of how he thinks the U.S. should be engaging with the world. And then, as I've mentioned, personnel will really matter a lot. And that is the point I've just made about the old Axe policy is personnel, or some derivative of that. But I think that will be true in this administration. It's generally true, and that is why we're putting our focus here. So very much a new, fresh model of the world, different from the Biden administration. And we're tracking this quite closely, particularly with regard to a very dangerous geopolitical backdrop. I think we have two live wars. We have great power competition, a concerted set of countries, China, Russia, Iran, North Korea among them, challenging the Western-led order. And so Trump's approach here will be really key to watching these geopolitical dynamics play out.
Can't agree more with you there. Thanks so much, Jack, for your insights and for your time. I really appreciate that. I next want to invite Natasha Sarkaria, who's investment strategist for BlackRock's EMEA team, to share her views on the post-US election investment landscape. Welcome to you, Natasha.
Thank you for having me.
Natasha, my first question to you is, how has the outcome of the US election impacted investor confidence and particularly perceptions around global market stability heading into 2025? What might change in coming months, and what personally makes you optimistic?
Sure. So let's start in the US, because that is where the election took place. The passing of the election itself and the removal of political uncertainty has led to essentially risk-on sentiment coming through in markets. So if we look at ETP flows, which aren't perfect, but they're a nice indication of where money went last week, for example. We saw 12.7 billion added to US equity ETPs last week from the 1st to the 5th of November. But then from Wednesday to Friday last week, that rose to 43.5 billion. So you can really see that there is money on the sidelines that was looking to come back in. Those perceived Trump trade winners also picked up in flows. You saw 7.1 billion to small caps, 2.1 billion to financials as well. But ultimately, the passing of the election itself, it removes a key pillar of uncertainty from the markets. Markets don't like uncertainty. They don't like change that they can't price in. So the sentiment rally we've seen really does reflect that removal of that political risk premium, alongside being driven by those certain exposures that reacted well in 2016 as well. So all in all, what we see is room for incremental risk appetite to pick up, given how much cash there was on the sidelines heading into the election. So if we look at the Bloomberg Money Market Fund, for example, that that index that comes through, that still points to 6.5 trillion of cash on the sidelines, yet to be put to work even this year, even a record year for ETP flows globally this year. There's still a lot of cash on the sidelines. So although investors have been adding, we've seen in the US, the removal of political uncertainty has really sort of supercharged US equity flows. And when we're speaking to clients as well, what we've heard is that investors, because no one knew how this election would play out, they were happy to wait on the sidelines in terms of their EM equity allocation as well, and in terms of some of their fixed income views, just to see how it played out. The only area where I'd say the views haven't changed would be in sort of the US rates environment. That was because we saw both Harris and Trump as net inflationary. And it saw basically yields poised to rise no matter who won. I mean, ultimately, it looks like it's going to be a red sweep, which is why we saw the dramatic moves we did on the day. But our implementation was the same no matter who was going to win in that environment. So that's the only area where we haven't really seen a big shift versus anywhere else. So more risk on in general.
That's fascinating that you say there's still a lot of cash on the side waiting to be deployed. And as the dust settles and it becomes more clear what policy direction will likely be taken, that will be deployed. It's fascinating. I know about a month ago, BlackRock put out a report that suggested that irrespective of whether Trump or Biden is elected, yields will rise at the long end of the yield curve, indicating that there will be more inflationary pressures from more fiscal spending, irrespective of the candidate being elected. So, you did say this before the election. You're saying it afterwards. So at least like you mentioned, that part was not necessarily uncertain. Very interesting views on equities as well. Natasha, what's your approach at BlackRock for identifying and capturing some of the opportunities presented by this new administration that's possibly on offer in the market? How do you position yourself to now say, right, tactically, or in whatever capacity, this is how we're going to take advantage of the opportunities the way that we see it? Do you have a process to do that?
Yeah, sure. So actually, I'd say our view at the moment on the US in particular, I'm going to start there, is mostly macro driven. And it hasn't changed after the election. In fact, I'd say we're doubling down on it. So at present, the reason I started in the US is because we actually have the most conviction in the US in developed markets. And we're comfortable buying into equity market breadth, which means we're comfortable buying the whole index, the whole market at the moment. And that's for two reasons. One is a solid macro backdrop. Now, growth is unremarkable, but it's not in recessionary territory. So it's not like that we think there's going to be a recession next week or next month. Growth is unremarkable, but still relatively solid. At the same time, you've got the Federal Reserve cutting rates on their cycle. They're in the middle of it for the time being. They cut rates last week. They won't be done in the immediate future either. So the macro backdrop is, by definition, getting easier from a monetary policy perspective. So that creates a supportive environment for risk assets. And that's the top down. If we're looking at the bottom up, which is number two, that's also improving. And if we look at that as defined by earnings, for example, US earnings were in a recession at the start of the year. And that wasn't too long ago. We're literally in an earnings recession. Now we're at 7% EPS growth in Q3. We had 9% in Q2. All sectors are expected to deliver positive earnings by the end of the year. So the top down and the bottom up are essentially improving at the same time, which makes us comfortable buying into that market on the whole. What I'd say is in terms of how we were looking at it around the election itself, one thing that we shifted with this year, given you mentioned the proliferation of elections this year, was that we were comfortable staying invested through DM elections. So if you thought UK, US, for example, but in EM elections, what we've seen in the past is that there is a little bit of event risk around the election itself, which has played out in the equity market. So we stayed on the sidelines until the results became clear in EM elections. So it's a slightly different answer to your question in that the election in the US didn't really shift our asset allocation because we were comfortable staying invested. But it's different to in EM, where we've waited until the result has become clear. But elsewhere in the US, and sort of how we're taking advantage of some of the opportunities that you mentioned, we've also got sector convictions. So banks and financials, for example, is one of our long-standing overweights. It's an under-owned sector in our view. We actually saw it at the start of the year as a trade that would be unaffected by whoever won the election. And it just so happened that it actually did particularly well in the past couple of weeks as well. But we also think it can withstand a rate cutting cycle because of the increasing capital markets activity. It's something that we've seen coming through in earnings as well in this reporting season in particular. And we've also got a little bit more comfortable going down the capital stack in credit. So we're comfortable buying across credit now. Across at the start of the year, it was more to do, we had a higher preference for IG over high yield. And now that relative value has slightly eroded. So we're more comfortable buying across credit as well.
That's fascinating. And what you piqued my interest there in terms of your comments on EM, and I think we already have one of the questions is around EM and where the opportunity is, whether there's opportunity in China, India, South Africa, other emerging type economies. Now, on that, what is your view on EM equities and specifically, and where the opportunities are? I take your point that developed market equities look attractive from the perspective of just structurally look attractive, although many would argue that valuations are somewhat stretched in developed markets, and that EM is the perennial undervalued, unloved underdog, I suppose. And the question for me is just where in EM do you see potential opportunities, and how do you see this playing out post-election?
Sure, and I'll get to that question as well that came through from the Q&A as well. But again, as a spoiler alert, post the US election, our conviction didn't change. In EM, our highest conviction continues to be India, and that's for three reasons. One is the solid macro backdrop. You have consistently between 6 to 7% growth. Although inflation has picked up, growth is consistent and fiscal discipline is high. There is potential for the Reserve Bank of India to cut rates at the start of next year. We've been in the camp of the start of next year anyway, and I think more investors are joining us there as the inflation came in a little bit ahead of expectations. So the macro backdrop's relatively solid. Number two is the diversification prospects. So Indian equities, by virtue of not being owned very much by international investors, are less correlated to both global equities and US equities than a broad EM equity allocation. So they're also lowly correlated to Chinese equities as well. It's a sort of 0.3 over 23 years. And the same is true for bonds. It's really the diversification prospect that keeps us in that sort of overweight territory for the time being, especially because within EM, the dispersion that you see is a key characteristic of markets this year. You've seen sort of 60% difference between the best and worst performing EM equity market, for example. Much has also been made of the domestic investor. And that's actually number three of the reasons that we like Indian equities. So we've seen a lot of comments about retail investor exuberance and how investors may have gone too far in terms of playing around in the market itself. But we see those investing directly in equities as sticky money. And that's data that has been backed up by the Regulatory Commission and publicly available data on sort of the creation of accounts in India and trading accounts. And that's key for the long-term prospects of the equity market, is keeping that domestic retail investor interested over time. So that's also the reason that valuations have run up, but we're comfortable paying for this exposure at present. So our highest conviction is India and EM. Elsewhere, we think the tailwind for Asia on the whole is broader. The reason for that is the actual Federal Reserve. So EM central banks started their rate cutting cycle before the developed markets did, before the Fed, before the ECB. But they reached a point where they had to wait for the Fed to continue to start their rate cutting cycle in order to continue. And now we've reached that point. So there's room for EM central banks, particularly in Asia, to start to cut over the next quarter or so. And that would be, again, make monetary conditions easier, net positive for risk assets in general, and also net positive for EM local currency debt as well. So we're comfortable on the debt front as well. Elsewhere, what we've also done is upgrade South African equities to a more balanced view. That was partly after the election, and given the positive backdrop for iron ore demand, given the economy's role as a key exporter. Whilst we've seen the equity market give back a little bit into November, it's bang on in line with EM equity performance since the start of September. So it's really, it's not too bad and in line with our sort of balanced view that we have. And over in LATAM, there's a sort of question on Brazil. in particular. We're staying mixed on Latin America. Mexico is an expensive equity market that hasn't delivered on earnings, and it's had a high beta to the US election. It's got a high beta to US growth and a high beta to the US equity market as well. And Brazil has had poor earnings and is continuing to derate. So we're just staying on the sidelines until the earnings and the fundamental backdrop improves in both Mexico and Brazil, because that needs to start to back up some of the valuations that we've seen after basically a couple of years of outperformance for Brazil in particular. So our highest conviction is India. We're broadly more positive in Asia than we are elsewhere, and more balanced on South Africa as well.
Thanks, Natasha. That was a phenomenally detailed response and great insights that you shared with us. Thank you for your time and appreciate your views there. I next want to bring on the stage Rolf Thomas, who is the head of balance funds at Sanlam Investments, to share his thoughts with us too and provide a local focus to this discussion. Hello and welcome, Rolf. Thanks for joining us.
Hi, Nico.
So, Rolf, firstly, how has the election results and the uncertainty in its run-up affected your own asset allocation decisions? And has this factored into your positional thinking going into 2025? Or do you just see it as a noisy distraction to your long-term positioning?
A little bit of both. I mean, to try and understand our views, you need to understand how we go about investing. We're pragmatic value investors, so we are fundamental investors. So we always try to invest in line with where we see value in terms of the asset class or asset allocation that we put on. So coming into this year and before the election results, and before the election event, we were obviously evaluating different asset classes. And the one thing that got us a little bit concerned is how hot, let's just say, foreign equity was getting. Specifically, I'm talking about the S&P 500, so U.S. equities, but excluding the Magnificent Seven. And then on the basis of that, we started reducing our weight to foreign equity. And some of the reasons behind that is, if you have a look at the valuations on that sector, the excluding Magnificent Seven S&P 500, you've sort of seen long-term growth in earnings of around 7% for that group of stocks versus expected growth from that group of stocks going forward to be around 15%. It's a bit of an optimistic view, even with interest rates coming online, to expect them to grow double what they have, over the last sort of 15 odd years is quite an ask. Just for a reference point, the Magnificent Seven, for example, their trailing earnings per share growth is somewhere in the region of about 21% over the same period. So their forward PE around 21 versus maybe a fair PE of around 15 for that stocks made us a little bit uncomfortable. So we had actually been reducing some foreign equity more recently, just before the elections on the basis of valuations. That was a convenient action because the uncertainty around the elections, also obviously we don't really like uncertainty for some of the reasons that the previous presenters mentioned. It increases the cone of probabilities of what can sort of occur. So for valuation reasons, we sort of reduce a little bit of risk. But if I had to look at our other asset allocation, the other moves that we've had or other sort of views that we had, we are largely constructive on SA. We've still got an overweight to South African bonds, currently indicating about 5.2, a real return of around 5 or 5.2. That is a very attractive return, albeit not without risk. South Africa's got its own risk factors attached to it. But that recent re-rating that we've had with bonds, even all the way down to this sort of 5% indicative real return, you must put that into context. I mean, long-term South African equities have given you around 5.5% real return. So you are picking up very near equity-like equity-type returns, but obviously with significantly lower risk that comes with bond investing as opposed to equity investing. We're also constructive on SA equity. We overweight SA equity and SA bonds. And what we've seen over sort of the last 5 or 6 years is there's sort of been this constant discount of around 20 to 25% in the SA market relative to our analyst view of what intrinsic valuation is. Think of it as our fair value. With the recent, after the South African elections, we've seen quite a rally in South African stocks. And that discount closed from that 20 to 25% to around 15%, albeit we still do see upside in SA equities. More recently, I mean, we've got positive GNU momentum, that's sort of fueling markets. We've had really good macro prints in terms of PMI, business confidence, consumer confidence, although still negative territories on the rise. Retail sales were positive. We've had electrical supply that has been stable. And all of these are sort of boosting sentiment around SA equity. Haven't really seen really strong growth come through yet, but that is largely the expectation. I'll maybe just mention, sort of on the back of reducing some of that foreign equity allocation that we had, we've also got a healthy amount of hedging on in the fund as well, just in the event that something unforeseen happens. The often talked about recession that's probably going to be, hitting the news far less these days compared to where we saw it in the past. Just to protect, sort of the positioning in the fund and protect our investors, for example. And we've been sort of underweight foreign bonds for some time. If I had to renew the call for that underweight to foreign bonds, I would definitely echo the previous speakers in terms of our expectation of, largely inflationary policies, regardless of which camp won, largely positioned that way for some time now.
Thank you. You cut out there for a second, Rolf, but I think you're back. Okay, so interestingly, Trump this year mentioned that tariff is his favorite word in the dictionary, and even threatened at one stage 100% tariffs on imported goods where he sees U.S. manufacturing being, in his view, undermined. Now, optimists argue that his stances will soften and his administration will be more market-friendly, more pragmatic than his campaign messaging would indicate. In fact, a lot of, sort of his proponents have said, don't take him at face value. He says these things to impress the crowd, but when the tacky hits the tire, it will be far softer. Now, opponents, however, see dark skies ahead, particularly for global trade and the impact that this will have on EM countries that have large export markets, particularly in raw materials like South Africa and other emerging markets. China comes to mind in terms of resource-driven economies. Now, do you see opportunities being created by a possible recalibration of trade policy and the U.S. governance structure? I mean, are they short-term opportunities that you feel present themselves, either reducing allocations or making allocations, apart from your sort of longer-term value-oriented stance that you mentioned? Are they kind of short-term opportunities that you hope to take account of, or how do you see this playing out in 2025 and beyond?
Yeah, that's a very good question, Nico. I mean, we typically position for the long term. If you had to press me for my short-term expectation, I do definitely see short-term benefit for the U.S., and I'm talking about equities here, with the Trump administration coming in. I mean, one of his big campaign promises was, renewing of tax cuts, corporate tax cuts, and actually, increasing those cuts. That's going to be a once-off boost to profitability for earnings for U.S. companies. Also, looser interest rate policy. I mean, Trump has spoken quite a few times about, he wants the Fed to effectively directly report into him. So he wants to have the final say in terms of monetary policy. That we can expect monetary policy to be looser than you would have expected under, let's just say, the previous Biden administration, and a little bit more conflicted Fed, a little bit more interference in the Fed. So I would expect a looser interest rate policy, and the combination of deregulation. That's obviously also going to be good for U.S. companies. All of those definitely have short-term benefits. However, the sustainability of those things is the thing that's really under question. If you look through all of this, if you look across all of his policy suggestions and campaign promises, I picked up an interesting stat from the Pearson Institute of International Economics that modeled the impact of their tariff increases, the migrant deportations, and the fact that you potentially have a compromised Fed. And their low impact scenario, so their conservative estimate, is they expect it to cumulatively reduce US GDP over the next sort of 3 years, the next administration or so, 3 to 4 years, by around 1.6% per annum. That's a significant reduction. Their high impact scenario out of interest is expected to or to drop GDP, US GDP, by about 3 times that. If you have a look at all the policy that has been mooted by Trump, you'll sort of see, the estimates are probably an 8% decline in US earnings per share after all is said and done. So short-term benefit for the US, yes. If I look a little bit more broadly and cast my eye across the globe, what Trump is coming into power on, his strongest ticket is trade, as sort of was mentioned before. The kind of tariffs that he's talking about is the world has not seen tariffs of that magnitude, not even in his first administration, his first term rather. But these are pretty large tariff increases. We've gone through a long season of sort of global free trade that has increased efficiency, driven prices down. So what we're going to be seeing happening is effectively a changing of trade, effectively a new sort of global world sort of trade order. And exactly how that sort of finds its footing is going to be interesting to watch. It's quite interesting that at the same time that the BRICS seems to be gathering, more and more strength, and there's increasing talk about BRICS increasingly trading amongst each other and consuming effectively a lot of the commodities that each of the different members produces. So that might be something to watch, but it is still very early stages in terms of, we'll only really have a better idea of how things settle once, Trump takes office and we start seeing some of the policies enacted.
Very interesting views there, and I take your point. The markets aren't easily fooled, and whatever short-term injection you can give to the market, be it tax cuts or otherwise, or favorable, regulatory changes, if it is temporary, the markets will price it as being temporary. And I don't, it remains to be seen whether any structural improvements can be made that will have long-term positive benefits as opposed to just short-term benefits. And the numbers you mentioned on possible decline in US GDP, those are sobering numbers, right? Because ultimately, at the end of the day, if that can undermine the structural growth path of the US, certainly that will have an impact. And it will be interesting to see how this new US administration comes about, whether their focus will be on driving short-term results, knowing that Trump won't be able to run for a third term. And so even if short-term results mean long-term pain, that might be acceptable for this administration, which is, again, a bizarre thought. But like I said, markets aren't easily fooled, and asset prices will reflect that. So certainly it's going to be very interesting to see how challenging the Fed's independence will actually play out, whether that will wreak havoc on bond markets or fixed income asset classes. Who knows? But really interesting views there, and thank you for your time. Rolf, next, I want to end off with Kingsley Williams, CIO at Satrix, and get his views on Satrix's long-term SAA positioning. Now, Kingsley, Satrix recently concluded our biennial SAA review process that determines the Satrix Balanced Index Fund positions. Now, can you briefly summarize your main asset class calls and also elaborate on how Satrix views asset allocations more broadly? We've heard some fascinating perspectives, political perspectives, economic perspectives, asset class positioning perspectives as well. Why don't you just bring us home in terms of how Satrix views asset allocations, and also has the US elections changed your long-term views at all?
Yeah, thank you, Nico, and thank you for facilitating such an interesting conversation with some really phenomenal insights from the panelists that you've had with this webinar. Thanks for the question. Before I get into our calls, I'd like to start with what our philosophy and approach is when it comes to managing certainly our two balanced unit trusts, which many of our clients and investors would be familiar with. And that's really underpinned by a philosophy of focusing on the strategic asset allocation. There's a lot of research out there which has confirmed that in excess of 90% of the variability in returns is going to be explained by getting your strategic asset allocation right, or function of whatever your policy benchmark is, which is essentially your strategic asset allocation. So we place a lot of emphasis and focus on reviewing and working on getting that strategic asset allocation into, as optimal as it can possibly be. Coupled with that, we also have a strong conviction in factors or styles, particularly within our local equity market. And research, again, has borne this out both globally as well as in our own market, that factors such as value, quality, momentum, etc., explain a significant portion of the active returns that are available within an equity market. And so we've got a lot of track record in that space and a deep conviction in being able to harness those factors within our portfolio. So that's a little bit of our philosophy. And so with that in mind, what we then do is review our strategic asset allocation, which I'll call our SAA, on a biannual basis. So that's once every 2 years. And the purpose of doing it once every 2 years is so that we discipline ourselves to maintain a longer-term systematic approach to evaluate the strategic asset allocation, and as a result, protect ourselves from not being drawn into which, while they have the potential to add value, they can detract as much value as well on the other side. So instead, we stick to a strategic asset allocation, which, as I've elaborated on, is designed to provide compelling returns through the cycle. And so by reviewing that SAA every second year, this allows us to take account of regulatory changes, such as our well-known Regulation 28 limits, which is used to govern the Pension Funds Act, what you can be exposed to as you're saving for retirement. And it also provides an opportunity for us to include or exclude certain asset classes and refine the strategy to ensure it is optimally positioned to deliver on its real return target. So that's a little bit about our philosophy and how we, what our approach is. But just to elaborate specifically on how we then approach reviewing the strategic asset allocation every second year, what do we actually do to arrive at any changes or a new SAA? And so we do this in collaboration with our colleagues. I know, Nico, you often make the joke about me coming up with all of these weird and wonderful ideas in a dream. It couldn't be further from the truth. We go through an extremely thorough process. Yeah, we go through an extremely thorough process with our colleagues across the Sanlam Investments business. This includes Ralph and various other multi-asset experts, as well as asset class professionals, to get their views on the landscape affecting those particular asset classes, so that we can form a view on what the expected returns are of each asset class over the medium to long term. We then collate those inputs along with the risk profile of each asset class, and then put it through various optimizers, which you are very familiar with, to ultimately determine the efficient frontier. And just for the listeners, that's basically the most optimal portfolio that you could achieve with the inputs that you've given the optimizer. So in other words, how much should be allocated to each asset class at different points of risk? What is going to be the optimal mix to deliver the highest return at different points of risk? And so this then provides us with very useful insights on how different asset class combinations interact with each other, which is not necessarily intuitively obvious. And it's used to inform any potential changes that we want to make to our SA. And then what we do is we test whether those proposed changes make sense at a multi-asset portfolio level, using both historical and expected returns. So what we're looking for is the portfolio becoming more efficient from both a risk or return or both perspective? And obviously, we're not going to implement a change unless both of those, one or both of those criteria have been improved upon. Now, underpinning this philosophy is that we believe our clients are best served by us rigorously focusing on the process that I've described, and looking through the short-term news and noise, which can often consume, our media and social media feeds, and can often give rise to panic and fear. So, following our recent SAA review, some of the bigger calls that we've made were actually to increase exposure to local nominal bonds, in line with some of the points made earlier by Ralph. So, and this is really off the back of an attractive return return profile relative to the risk that this asset class poses in a portfolio. And I must add, with significant potential for further upside, subject to a number of things playing out. Now, these are big ifs. Even if they don't play out, the return profile for nominal bonds looks attractive, but it could be even more attractive. And some of those reasons could be, South Africa containing its inflation. In fact, the Reserve Bank is actually considering reducing the inflation target, not without political pushback, I might add. But there is definitely a move to try and reduce our inflation target, and that obviously is very supportive to other South African assets. There's also a concerted effort to bring our debt to GDP ratios under control, and then hopefully in time an upgrade from our current junk status. So there's all of these potential further upsides that could be very supportive to nominal bonds. So that's why we like them. The risk-return trade-off of investing in nominal bonds is very favorable. Now, where was that upweight funded from? A big portion of that was funded by removing exposure to local inflation-linked bonds, which offer a form of insurance against inflation surprises, but that also comes at the cost of a drag on performance relative to nominal bonds through the cycle. So I think inflation is subsiding, but also that on a longer-term basis through the cycle, investors are probably not as well rewarded by holding inflation-linked bonds on a strategic basis as the returns that are on offer through nominal bonds. So that's on the local bond side in terms of one of the big changes that we've made. The other big change has been removing exposure to locally listed property, which we have as an additional allocation on top of the exposure that you would get through local equities. So we still retain the exposure that we have through our local equity allocation, but we've removed the additional allocation to local property. And this might seem a little bit counterintuitive, particularly as we are also in that rate-cutting cycle, which investors might reasonably expect to be very supportive to property. So what's been the thinking behind that? So useful to provide a bit of context. We did have quite a material allocation to property if we look back a couple of years on what that strategic asset allocation was within our balanced funds. And that has been reduced, but we chose to keep that static in 2022. If we rewind, you'll recall property took a very bloody nose following COVID and lockdown, and commercial properties no longer being utilized, people working from home, etc. And so our view at that time, 2 years ago, when we last did our SAA review, is that property was deeply undervalued, and it would have been the wrong time to sell out of that asset class. And we've definitely been vindicated with that decision, as we've seen a very strong recovery in property since then. And so we feel now is the right time to take that risk off the table. Our view is also that we can obtain far more broadly diversified exposure to the listed property asset class globally, which will similarly benefit from the reductions in interest rates which expect to continue occurring. And in fact, I've just seen a headline come through today that Trump's administration and presidency could be very supportive of commercial property, particularly in the US and globally. So having exposure and retaining exposure to listed property offshore, we still have that, and that's obviously a far more broadly diversified way of capturing that particular asset class than it is doing so locally in South Africa only. And yes, while local property may benefit from the tailwind of reduced interest rates, we have a lot of direct exposure to that trend playing out through our increased allocation to local nominal bonds. So that's a far more direct exposure to capturing that particular macroeconomic development. So yeah, Nico, that's it in a nutshell. Those are the big changes that have been implemented in September. And yeah, we look forward to seeing our two balanced funds continuing to deliver the great returns that investors have experienced in those products.
Brilliant. Thank you for your perspectives, Kingsley, and for sharing with us in detail how that process unfolded. It was certainly a fascinating time to be part of that as well, and collate the thinking, do the analytics, and debate this internally. what an interesting time we're living in. Jack made some very interesting points around potentially the pragmatism with which Trump will approach trade and policies and international cooperation. It might not be all doom and gloom. It might actually be quite pragmatic. Natasha made some very interesting points as well around DM equities and the sort of structural potential tailwinds that's faced there for DM equities, despite its potential stretched valuations, that BlackRock still sees value there. Globally, bonds, interesting asset class as well. Certainly, from all perspectives, it seems that the U.S. administration will be more expansionary. So look for higher yields towards the longer end of the yield curve. Of course, that might have an adverse impact in terms of capital depreciation on your long-term bonds, specifically DM. Ralph and Kingsley made great points around not being swayed too much by noise in the short term, keeping your eyes on the horizon, and just finding those opportunities that are on offer. And the interesting Peterson Institute that Ralph mentioned that kind of see potential headwinds for the U.S. economy from potentially having higher or tariff increases, aggressive tariff increases, migrant deportations, and a compromised Fed. So a lot of things to keep your eyes on. And certainly Natasha made the point that there's historical high number of assets still remaining on the sidelines in cash, in money market funds, waiting to be deployed as markets wait to see where the opportunities are. And as the dust settles and that becomes more clear, and certainly for all of you dialed in, that means now's the opportunity to take chances if you're so inclined, or from our perspective, focus on the long term, make sensible allocations, and just and Ralph made this point as well. Just take uncertainty off the table and narrow your cone of possibilities and focus on growing wealth long term. For all of you that attended, thank you so much. It was a fascinating discussion. Jack, Natasha, Ralph, Kingsley, thank you for your insights, and we will see you in our next Index More event. Thank you for attending.